Good morning. This is Mornings with Michael for information and educational purposes only. Our show today, we're going to show the dangers of a bear market. We think we're in a bear market that possibly could be worse than 2008. We just don't know yet. But first, our word of the day. Word of the day is Betoken. Betoken, a sign, a warning, an indication. It couldn't be more appropriate for our show today. A smile that reaches the eyes can betoken genuine happiness. Here's our S&P 500 chill map. Definitely a chill map for the NASDAQ, IWM, QQQ, and the Dow Jones Industrial Average. The only ones that were up were healthcare, real estate, utilities, and consumer cyclicals. So that is the story there. Let us just keep on moving on. We're going to go over to our PowerPoint presentation. I'm going to take a step back because some people say they're confused or don't quite catch up, know as much as I do. This is a bullish engulfing. It engulfs 3 days in a row. This is bullish doji. Still needs more information. Doji means a change may be underfoot, so it needs more information to find out what that change is. This is another example of a doji. That change is turning to bearish right here. This is a bearish engulfing. And this is another version of the bearish engulfing. This is a falling star. Falling star usually means bearish trend is ahead. So that is the story there. This is another doji, followed by a falling star, means a bearish trend is ahead. So that is the story for that. Here's the bearish engulfing candles on the Dow Jones. It engulfs 1 day or more, which is 2 days here. Bearish engulfing on the IWM or small cap index engulfs 3 days, it looks like here. On the NASDAQ, engulfs 2 days. And on the S&P 500, it engulfs, it's like a day and a half. So that is the story. We're moving on to our Dow Jones Industrial Average. This is a bearish engulfing, engulfs a number of days, perhaps an entire week. And it gaps down further. Just try to repair a little bit. We got huge volume here, huge volume here. Believe that this is going to pull back to 392.18 and then bounce to 400.08, where it'll probably run into this moving average, which prior provided support. As you can say, it bounced off the line, and now it's going to provide resistance, and it'll get turned away from that line as that line continues to turn downward as the price is below it. So that is the story. And you can see you've got a hook here, the stochastics, and a hook on the commodity channel index going all the way down. So, but eventually we think we're going to get a bounce onto our small caps. This is the IWM. Instead, we felt last week we felt it would at least come down here to this gap and maybe bounce from there, but it has gapped down significantly. And it has filled these two gaps. We believe it could pull back to 203.82 and then bounce to 216, where I think it'll get turned away by this moving average. And then we move on to the NASDAQ, the QQQ. The NASDAQ gapped down like all the other indexes. Look at this. No, we have not moved down to the NASDAQ yet. Sorry about that. Here's the NASDAQ. Here's the bearish engulfing, engulfs an entire week. Tries to move up. Here's a doji presenting a change as a foot. We got this fall, not really a falling star, but this is our signal, hanging man. And the hanging man leads to a gap down. And look at this big move. I believe the NASDAQ is going to fall to 441.80 and then bounce to 458.89. The volume is getting higher. So I think at least Monday or Tuesday could move up. So that is the story there. And we got a hook on the stochastics, and the hook has turned down on the CCI. So that is the story there. Here we go. Here's on a monthly basis, the NASDAQ kind of reached a high, got a doji, which signals changes afoot, and the change is bearish, and it is pulling back. Anytime you get this far above the moving averages, tends to have a sell-off. Got a volume pretty high here. It is turned down the volume a little bit here, but we've got a hook on the stochastics, and we've got a hook, and it is now following into a decelerating pattern here on the commodity channel index. We move to the S&P 500. We've got a bearish engulfing right here, gap down. This is, looks like, could be an inverted hammer on the end of bearish. The volume is receding a little bit on Friday. Got a hook here and definitely hook down here. Believe it will fall to 528.60 and then bounce, get close to the moving average up here before it gets turned away. And we move to the VIX. Actually, this is the S&P 500 where we showed similar a couple of weeks ago. Reach up here, 566, and then get turned away. This as a falling star. Volume is receding on the bullish side, and looks like we got a little bit of a hook. Did move up here a little bit. We'll just see if it turns down on a monthly basis. And now we move to our VIX. Huge move on the VIX. Definitely past our 1838 number. I think it'll pull back a little bit here eventually. The S&P bounces. So the VIX, along longer term trend, I think it's going to go to 41.88. These are some of the problems ahead of us for the financial markets. The national debt just keeps going up and up and up. $483,889 per child. This was on July 29, 2024. As you can see, $6.4 billion in new debt every day, $74 million in new debt per second. No, that's actually $74,401 in debt per second. $4.5 million in debt every minute, $268 million in new debt per hour. That is kind of scary. Once again, our folks in Washington have not served greater interest of us, the people who elected them. Small business employment growth is now negative on the ADP year-over-year payroll, at negative 88,000 for small business size 20 to 49. Trends are negative in all but very large corporations. So there we see that. All these numbers, you can take a look at it year-over-year, January through 1 through 19. I believe this is size of the company, 20 through 49, 50 to 249, 250 to 499, and the year-over-year 500 plus looks like it's the only one that's moving up. Here are the comparison of 2024 to 2008. Earlier in the year, we compared 2024 to 1929, compared it to big crash of 1929. We're moving into the fall part of the year when the markets do the worst. September and October are usually when we have the crashes. I believe that institutions are trying to get ahead of September and starting the selling early. So that is a story there. Here is Charles H. Smith from Of Two Minds in May of 2024. He was above the trend. What do we got here? Looks like we got a head and shoulders top. The middle is a head. Here's the left shoulder. Here's the right shoulder. He has an ABCD pattern. A lot of stock indexes move in ABCD patterns. We got a pivot at A, where we got the sell-off started. He thinks it's going to come down to B, pivot to C, not quite be able to overtake, and then propel lower to D, which is right about the pandemic 2020 lows, and then undercut those as well. He's saying everything AI bubble peak, inflation is tamed. Inflation is not tamed at this point. Inflation is tamed again, and then no more central bank treasury saves as this just continues to fall. That is Mr. Smith's belief. This is a Fed put. A lot of analysts think that the Fed has waited too long to raise interest rates and now have done the same thing from reducing interest rates. The Fed put is what the fear of missing out investor is hoping for, a September rate cut. As we've looked before, rate cuts often propel the market downward. They don't actually move it upward. And this is from Zynga. Laugh all you want, Robert Kiyosaki. Rich Dad Poor Dad says, warns millions of 401ks and IRAs will be toast after the end of this cascading down. So that is the story there. Let us take a look here quickly. This might be where you want to roll over your money. It only goes up when the market goes up. It doesn't come down when the market goes down. Beats index investing by about 5% per year and will save your 401k from turning into a 201k. And we're going to look at what happened in 2008 in a little bit. Started in November 1st of 2007. Here's a look at it. This is the mammoth fall. We tried to come up here a little more. Got some investors thinking it was over. Fell again, not quite a double bottom. And it wasn't until March of 2009 that it started to improve. So all 90 to 95% of the money has to go somewhere. And we're going to take a look at some of those places where it is moving to. This is XLP, consumer staples. My other monitor, not on yet. Let's see if that'll, here it is. So we had unplugged from our monitor, so we don't get to actually use it, but just to take a look at a few of them. Procter & Gamble, moving up, Colgate, got a little bit of a pullback in Colgate. Coca-Cola and Pepsi. Holding up. What is the other one? XLU. I guess I have not moved us back to the present day. Here's XLU, XLP. So that is kind of our story there. Looked at 2008, 2009. Consumer discretionary, consumer staples. XLV, healthcare, seems to be holding up. And real estate continues to move up. Metals and mining dropping, energy dropping, financials are dropping, semiconductors, big drop in them. So building materials. Home builders did bounce back after they had a big pullback. Airlines, big cascade down. Out of the office, big cascade down as well. So that's where we're going to wrap up our report for today. It is a very precarious situation out there. If you have money in your 401k, 403b, I would suggest start moving some of that money. You don't want to let your money be cut in half. Things are really precarious, and sell-off has definitely started. You saw all the charts that I've followed. If you have any questions or comments, feel free to comment, and we'll look forward to seeing you tomorrow.